You ever have this moment? You're feeling responsible. You've been paying your bills. You've got a decent job. You finally decide, you know what? I'm ready to finance a car or maybe apply for a better credit card. You fill out the application. You feel good. Then you get the email based on your credit profile, and suddenly you're staring at a number you don't fully understand that somehow controls whether you pay 3% interest or 18%. And you're thinking, I pay my bills, I don't do anything crazy, why is my credit score acting like I committed a crime? If that sounds familiar, that's literally most Americans. My name is Max Ladger, and I spend way too much time thinking about how money systems quietly control your financial life. If you're someone who feels like your credit score is this mysterious number that randomly goes up and down and somehow decides your financial future, make sure to hit the subscribe button and give this video a thumbs up if this helps you out, because today we're breaking this down. Not the myths, not the TikTok shortcuts, but how credit scores actually work in the US. And here's the thing, once you understand it, the system becomes predictable, and predictable systems are beatable systems. Let's challenge something right away. Most people think a credit score measures how responsible you are with money. It doesn't. It measures how profitable you are to lenders relative to risk. That's it. Your FICO score, which 90% of top lenders use, ranges from 300 to 850. According to FICO, here's how they categorize it. 800 to 850, exceptional. 740 to 799, very good. 670 to 739, good. 580 to 669, fair. Below 580, poor. The average FICO score in the US is around 715. So statistically, most people are sitting in the good range. But here's what most people don't realize. The difference between a 670 and a 760 score can cost you tens of thousands of dollars over your lifetime. Same person, same income, different score, different financial reality.
Your FICO score is calculated using 5 categories. Payment history, 35%. Credit utilization, 30%. Length of credit history, 15%. Credit mix, 10%. New credit, inquiries, 10%. Let's break this down like adults. Payment history, 35%. This is the biggest factor. Miss a payment by 30 days, it can drop your score 60 to 110 points. Let me say that again. One late payment, 60 to 110 points. That's the difference between a 760 and a 650. Now here's the psychological trap. Most people don't miss payments because they're irresponsible. They miss them because of friction. They forget, they move, they change bank accounts. They assume autopay is set up. The system punishes carelessness, not just recklessness. Action step. Put every bill on autopay. Then manually review once a month. 0 excuses. Credit utilization, 30%. This is where it gets really interesting. Credit utilization is how much of your available credit you're using. If you have $10,000 credit limit and $3,000 balance, that's 30% utilization. Experts recommend staying below 30%. But here's what most people don't realize. Under 10% is where elite scores live. Now let's do math. 2 people. Both have $10,000 limits. Person A carries $5,000 monthly, 50% utilization. Person B carries $800, 8% utilization. Even if both pay in full, person B looks statistically safer. Why? Because lenders don't see your intentions. They see your reported balance. And here's the psychological piece. When people get a credit limit increase, they see it as spending permission. The system sees it as risk measurement. Those are 2 very different things. Action step. Keep reported balances under 10%. Pay down cards before the statement closing date, not just before the due date. That one move alone can jump a score 20 to 40 points. Length of credit history, 15%. Look, this one frustrates people because it's mostly time. The average age of accounts matters. Close your oldest credit card, your score can drop, even if you never use it. Now you might be thinking, so I'm supposed to keep a useless card open forever? Honestly, yes, if there's no annual fee, because age equals predictability. Predictability equals lower risk. Credit mix, 10%. This measures whether you can handle different types of credit. Credit cards, revolving, car loans, mortgages, student loans, installment. Now, here's where people make a mistake. They think, I need more loans to improve my credit mix. No, never take debt just to improve a credit score. Credit mix matters far less than payment history and utilization. This is seasoning, not the main course. New credit. Every hard inquiry can drop your score 5 to 10 points temporarily. But here's the nuance. Multiple mortgage inquiries within 14 to 45 days usually count as one. Same with auto loans. The system expects rate shopping. What it flags is desperation. 5 random credit cards in 3 months? That signals instability. Let's run numbers. 2 people buying a $300,000 home. Person A, 760 credit score. Person B, 660 credit score. According to historical mortgage rate spreads, that difference can mean about 0.75 to 1% higher interest. Let's say 1% difference. On a 30-year loan, 760 score, 6%, 660 score, 7%. Monthly payment difference, roughly $190. Over 30 years, $68,000. Same house, same city, different credit education. That's a car, that's college tuition, that's retirement funding. And this is why I get slightly frustrated when people say it's just a number. No, it's leverage. Here's what most people don't realize. Credit scores reward restraint, but the modern economy rewards spending. You're constantly marketed to buy now, upgrade now, finance now, 0% now. And psychologically, when you swipe a credit card, your brain registers less pain compared to cash. MIT research has shown that people spend significantly more when using credit versus cash because the emotional friction is lower. The credit score system quietly tracks that behavior. So the system is watching. Do you borrow responsibly, or do you drift toward your limits? It's less about wealth, more about behavioral predictability.
Let's clear a few up. Myth number 1. Checking your own credit hurts your score. False. That's a soft inquiry. Myth number 2. Carrying a balance helps your score. Absolutely false. Paying interest does not improve your score. Myth number 3. You need to be in debt to have a good score. No. You need to use credit strategically. If your score is under 700, here's what I'd do. Step 1. Pull your reports from annualcreditreport.com. Dispute errors immediately. Step 2. Pay down cards to under 10% utilization. Step 3. Set auto pay on everything. Step 4. Don't apply for anything for 90 days. Step 5. Ask for credit limit increases without hard pulls. Most people see 30 to 80 points increases just from optimization. Not magic, just math. This is where it gets really interesting. A high credit score does not mean you're wealthy. It means you're reliable with debt. I've seen people with 820 scores and negative net worth, and people with millions in assets who barely use credit. Your score is a tool, not your identity. And here's the mindset shift. Use credit to build assets, not to finance lifestyle inflation. Look, the credit system isn't emotional. It's mathematical, but your behavior around it, that's deeply psychological. If you treat your credit score like a game with clear rules, you win. If you treat it like a mystery number that randomly moves, you lose money quietly. And over decades, quiet losses compound. So here's your action plan. Check your score. Lower utilization below 10%. Automate payments. Stop applying for random credit. Play long-term. Because the difference between confusion and control is education. And once you understand how the system works, you stop being punished by it. If this helped you see credit differently, hit the subscribe button. Because on this channel, we don't just talk about making money, we talk about keeping it. I'll see you in the next one.